In this video, I will show you how to create indexed retirement insurance contracts that credit interest to your money by tracking the gains of a market index, like the S&P 500, without the risk of losing any of your money whenever the market index is down. However, the interest rate credited to your money is not the actual gain in the market index, because your money is not actually invested in shares of the index, nor in the stock of any companies that make up the index. This means that the interest rate credited to your money only tracks the gains in the market index. The difference between the actual index gain and the interest rate credited to your money is typically determined by one or a combination of four rate factors: a par rate, a cap rate, a margin rate, or a bonus rate. Let's begin with the par rate. A par rate is a percentage of the index gain that will be credited to your contract each year. For example, if the par rate is 80% and the index is up 10%, your interest rate would be 8%. If the index gain is only 5%, your interest rate would be 4%. However, some contracts might offer a par rate that is higher than the index gain. For example, if the par rate is 120% and the index is up 10%, your interest rate would be 12%. If the index is up only 5%, your interest rate would be 6%. Of course, if the index is down 10%, your interest rate would be 0%. Next is the cap rate. A cap rate is the maximum interest rate that can be credited to your contract value each year. For example, if the cap rate is 8% and the index is up 10%, your interest rate would be 8% because the interest rate cannot exceed the 8% maximum. But if the index is up only 5%, your interest rate would only be 5% because the index gain is lower than the 8% maximum. Next is the margin rate. A margin rate is a flat percentage, like 2 or 3%, that would be subtracted from the index gain. For example, if the margin rate is 2% and the index is up 10%, your interest rate would be 8%. If the index is up only 5%, your interest rate would be 3%. The fourth factor used to credit interest on money is the bonus rate. A bonus rate is a percentage of the money you put into the contract that is added to the contract, but only if you keep your money in the contract for a specified number of years. For example, if you put $100,000 into a contract with a 10% bonus rate, an additional $10,000 would be added to your contract. However, this bonus money would only become permanent after a specified number of years. Until then, the bonus money would earn the same interest rate as the money you put in. If you take your money out of the contract too soon, you would lose the bonus. Some indexed retirement insurance contracts will often combine 2 or 3 of these factors. For example, your contract might give you an 80% par rate with a 10% cap rate. In a year when the index is up 15%, your interest rate would be only 10% because the par rate would give you 12%, but the cap rate would limit you to 10%. This is just one example of why it's so important to understand how these various factors determine the interest rate credited to your money. With a retirement insurance contract, you are trading a percentage of the potential gains for the safety and security of your retirement savings. Still have questions? Talk with the retirement insurance professional who asked you to watch this video. Schedule a consultation to explore how this strategy can enhance your financial security and pave the way for a prosperous future.